Good afternoon, everyone, and welcome to this panel on financing green growth. My name is Raby. I'm a partner at Astorg, a pan-European private equity firm that is involved in many respects in many of the topics we'll be discussing today. That being said, today the floor will be turned over largely to our panelists, whom have been assembled from very different parts of the ecosystem to be able to paint a broad brush of what we're trying to discuss today, which is financing green growth. So in alphabetical order, I will introduce the four panelists. First, Hervé Duteil, who's Chief Sustainability Officer for the Americas at BNP Paribas. As many of you know, BNP Paribas is one of the leading financial institutions in Europe and a major lender on the international capital markets, and is at the forefront of financing the energy transition. Bruno Guilmette, who's a Vice President and CFO of Boralex, which is a major player in renewable energy, based here in Quebec, but with today's operations really across North America and selected geographies in Europe, with a focus on renewable energy such as wind, solar, and hydro and storage. Rishi Kapoor, who's co-CEO of Investcorp, a leading global manager of alternative investments, founded in 1982 in the Middle East, with, as stated on their website, the objective of acting as a bridge between the Gulf and the rest of the world. And I think that thematic is particularly interesting in the context of financing the energy transition, where the Middle East can indeed play a key role. And finally, Learmonth, who is the CEO of Clean Energy Finance Corporation of Australia. The CFC is a quite, from my perspective, quite interesting organization, funded by the Australian government to invest across product categories in areas that can accelerate the transition to net zero of Australia. In many ways, the CFC is a pure play in financing green growth. So what I propose to do is first go around each of our panelists to perhaps address one topic relating to financing green growth. And after this round of initial comments, of course, we'll engage in the discussion as to the topic at hand and related matters. So first, I'll start with Hervé. Hervé, I have referred to the particular role of BNP Paribas. In many respects, you're well placed to answer this question. What elements should the financial sector take into consideration in order to accelerate investments towards green growth? And is sustainable finance really facilitating the transition and the base we need?
Sure. Thank you for this question and this invitation. First, we need to reflect on what is the role of banks and their contribution to climate-related policies. And policymakers have affirmed this quite a bit, and especially the network for financing the network for greening the financial system, the NGFS, which is this group that gathers primarily central banks. And the role of banks in this is really to finance the greening of the economy, not only the green economy. And that's something that I'd like to provide a light upon at this at the very beginning of this panel. Very much focus has been put on the green, and especially in Europe, actually, with the green taxonomy. But we strongly believe that it needs to be complemented by sectorial pathways, which will define the trajectory, if you wish. The taxonomy, the green defines the target where we have to be in 2050, but the trajectories will be different by industries, by jurisdictions, because by definition, the taxonomy is science-based, so it's common to all. But the transition pathways will really have to take into account the starting point. So, all in all, the role of banking is not only to support, obviously, the development of the green economy, but even more so this 80% of the economy that is not green today, cannot be green exactly tomorrow, and needs to transition. So this will help channel funding to the right companies, to the right projects, and avoid focusing incentives. And by that, I mean the focus of public investments or even development banks. It will avoid focusing those incentives on the narrow scope of already green assets. And I would finally say that we really need to, of course, we want to promote as much as we can the green, but the greening that is so much in need. If we forget it, we may create asset bubbles and even have a limited impact on greenhouse gas emission reduction. So, in a word, where the bulk of the financing is needed, at least in the banking space, is on the greening of hard-to-abate sectors.
Perhaps I'll ask a follow-up question immediately. You mentioned in your comments financing right companies, right projects, green or greening. When it comes time then in practice to notably extend credit to participants in the industry sector, in the energy sector, sorry, how do you think about particularly those that are involved in fossil fuels who may or may not have a detailed plan to move to a lower carbon footprint? How do you think about extending credit to those market participants who will be in fossil fuel production for some time still, given it's still part of the energy mix and will be for some time?
Absolutely. So it starts by defining our own targets first, and we joined the NZBA, the Net Zero Banking Alliance, back in April 2021. And as part of that, the first task was to set targets to get our lending portfolio to net zero by 2050. And last May, we actually published our intermediary target for 3 sectors, which are energy, fossil fuel and automobiles. And we decided, first of all, to set targets in 2025, rather than 2030. And the thinking was, if we set 2030 targets, the people today in position may not be the ones who will still be there in those exact positions by 2030. So by focusing on 2025, those in power today have to deliver. So to give you an example, in oil and gas, we took a commitment to reduce our lending exposure to upstream oil and gas by 12% by 2025, starting from a 2020 baseline, and in fact, by 25% in upstream oil. So first, we give a direction. Next, of course, it means we have to start becoming selective with our clients. And so we have this dialogue where we discuss about transition plan. Our portfolio will be aligned with net zero if our clients are aligned with net zero. So we need to give them a timeline, which are our own targets, but discuss what matters. And so the amount of capex dedicated to transitioning is something that's important to us. Their own commitments, do they have a net zero commitment? Do they have intermediate targets? And then the devil is in the detail, because we look at what that net zero target is really about, what scope it includes, does it include minority interest, etc. So it's all about dialogue. It's about being clear on where we're going ourselves. It's about giving timeline and then engaging the dialogue with those clients. Last thing I would say is, before defining those targets, we have also implemented ESG policies along the years. As you can imagine, we had a coal policy, we had a shale oil and gas policy, etc. Our latest version of our coal policy back in 2019 had defined a clear exit by 2030 from coal, from the entire value chain of coal, from exploration to power generation, by 2030 in European and OECD countries, and by 2040 in the rest of the world. So we're not new to this. We did attack the issue from different angle. Initially, we had straight exclusions of things that we thought today did not make sense anymore. But for the rest, instead of going into strict exclusion, we preferred to give a goal, like a 2030 exit, which gives ample time to discuss with clients and provide them the financing solutions to change the direction where they need to change.
Thank you, Hervé. Why don't we move to Bruno, Guilmette, and what Boralex does. Boralex is a pure play in renewable energy. So it'd be interesting to hear from Boralex, from you, Bruno, from two angles, frankly. One, perhaps within Boralex, your activity is really focused on renewable energy, yet you have broad corporate and social responsibility objectives. How do you think about both in the context of benefiting your company and its strategy and your employees? And secondly, perhaps, given you operate on both sides of the Atlantic, on projects where government financing and government relation is key, would be interested in your perspective on comparing your experience North America versus Europe from that angle.
Thank you, Jean. Thank you for the invitation. Yes, maybe just a brief introduction about Boralex. Boralex is a Quebec-based renewable energy producer that's been in business for more than 30 years. I mentioned the time because it's important. We focus on long-term sustainability, and I think ESG and CSR are topics about very much important for long-term sustainability. So we've grown the company. The company has doubled in size and capacity in the last 5 years. And mostly in wind energy, solar and hydro. Today, pure play renewable energy. We're based in Quebec. Our operations are in Canada. Half of our business, or almost half of our business, is in France, as Jean was mentioning. We have operations and assets in the US, hydro and solar, and we're developing also in the UK. So we're operating in countries that are mature, but yet have ambitious goals in growth in renewable energy, and that's important. We focus on those places where we have ample growth for the company, where the landscape is good for companies like ours. Our targets are ambitious. We are planning to double the company again by 2025 and double it again by 2030, which would see us at about 10 gigawatts of capacity by then. We're now at 2.5-ish gigawatts today. In terms of, and we're listed in Canada, we're the leading independent producer of onshore wind in France, and we're certainly one of the leaders in Canada. About CSR and ESG, it's very much intrinsic to our overall strategic plan. So it's not a separate topic. It's really included in our overall strategy, measuring, setting objectives, measuring, and putting tools in place to create value with non-financial items, non-financial elements of our strategy, such as our employees, our partners, our clients. In terms of partnerships, we've partnered with communities like the Innu Nation, which we've announced a project with them in quite a large project in Quebec. We partner with communities. We partner with municipalities. It's very much it's important for us to have the social acceptability of our project. So to us, it's part of our CSR approach. CSR, corporate social responsibility, and ESG, in our view, create long-term value, create long-term sustainability. I was talking about the 30 years. We want to be in business for another 30 years and plus. So very much and I can give you a specific example. I looked just before I came here, I looked very quickly at a few oil and gas stocks. For the last 5 years, their stock price is all of the ones I looked at are at the same price today that they were at 5 years ago. our stock price has doubled over that time frame. So that's what we talk about when we talk about long-term value creation, 5 years, but hopefully in terms of our thinking, it's 10, 20, 30 years. CSR adds value. CSR integrates non-financial items. CSR is clearly a long-term benefit to our business. In terms of your other question, Jean, comparing the experience we've had over time, and I was in pension fund management before I joined Boralex, and also on the board of the Canada Infrastructure Board, Canada Infrastructure Bank, and we've seen the evolution of CSR and ESG over that time frame. Pension fund managers were early adopters of such important elements. And the Canada Infrastructure Bank clearly is focused on such issues when they invest money. But also in the Boralex business, we've seen, I do a lot of relationships with our shareholders. When I started a bit more than 3 years ago, in 2019, we were meeting with investors in Europe, and clearly the topic of, especially E part of ESG, was very, very key and top of mind for them. In North America, a little bit less. It was not a big focus. It was important, but not yet a big focus. Over that time period, already we've seen North Americans, investors and shareholders catch up. Usually when we do a lot of those meetings with our shareholders and potential shareholders, and there's always a question or many questions around what's your ESG strategy and how do you go about CSR. So today we focus on procurement issues. We focus on the impact of climate change. Even in our business, it's important to see what does climate change do to hydrology. What does it do to the wind conditions in the long run? So we do a lot of analysis on that front. We focus on diversity and inclusion. We've done a sustainability-linked loan last year to become more communicative. So we've always been very active in ESG, especially on the E part, but we've certainly realized that we needed to improve the communication around it, the structure, the objectives, and on that we've also set ambitious targets. So our sustainability-linked loan is linked to two factors. One is the percentage of women in management, and the other one is CO2 emissions avoided. So that's, in short, Jean, maybe the answers to your question. We can't hear you. Jean, you're muted.
Apologies. After 2 years, I still make that mistake. So moving on to Rishi Kapoor. Investcorp is one of the global leader in alternative investments around the world. And I think you're particularly well placed to perhaps tackle this topic. There is a media narrative that cultivated the idea that for the trillions required to finance the energy transition and green growth, look no further than to asset managers and asset owners who are managing all this capital. But is this reliance on asset managers and asset owners a bit too simplistic as an answer to the capital needs to finance green growth?
Yeah, thanks, Jean. I don't know if I can pretend to do this while I'm on mute in a live environment. So let me start off with what you said. We are a global investment firm, and we have the benefit of deploying most, if not all, of our capital with two key considerations in mind. A, it's private capital, and B, it has a long-term horizon associated with it. And we are deploying that capital on behalf of our investor base that, by definition, again, comprises the most sophisticated, deep-pocketed institutions and family offices worldwide. their objective, if you take a step back, their objective is clearly to enrich the lives of future generations, right? The capital they are deploying into private markets, in private equity, in real estate, private credit, etc., is largely intended towards enriching the lives of future generations. So by definition, therefore, letting that capital talk for itself in terms of embracing as second nature, much like we embrace as investors risk and return, also embracing the principles of sustainability into everything that we do, is entirely not just appropriate, it is the foundation of investing going forward. This whole notion that a focus on sustainability or ESG considerations when they come into the financial investment world is a burden, it's a flawed notion. That's not the case. It is part and parcel of delivering on the mission statement of asset owners and asset managers like Investcorp, to address your question head on, Jean. However, having said that, yes, you're right, it would be a little, difficult for asset owners and asset managers to go it alone, because you require an enabling policy framework. That policy framework is going to come through a combination of government, through a combination of partnerships with the private sector, through a combination of multilateral bodies that come together, like the Sustainability Accounting Standards Board and the likes of that establish basically not just a guideline, a common platform for assessing progress along the way, but also help in defining what good looks like, right? Because I think we started off this conversation by saying there is green, that's the end goal, that's the objective, and then there's greener, which is the journey from here to that end goal. And that transition can only be implemented in a fruitful manner if we are able to measure progress along the way, right? Because it's impossible to execute on something that you can't measure. So what we've done at Investcorp, just as an illustration, and we are fortunate in that, being a private equity investor, by definition, we have a lot of control on our company. So we actually own the outcomes. We are not just making decisions in terms of investing based on inclusion and exclusion. Oh, I will not invest in fossil fuels. I will only invest in clean tech, etc. I don't operate like that. For me, every investment has to be evaluated on its fundamental merit. And if I can establish an initial baseline of where it is on its sustainability score and where I want to take it 5 years from then, and I can measure the progress every one of those 5 years in the interim, guess what? It's actually a good investment, right? Because that's what the world needs. It actually needs us as asset owners, as asset managers, to help the companies that we invest into, the companies that we own, the management teams that we are backing on that journey, whether it's on the E or the S or the G. We actually at Investcorp, we developed our own, we call it the responsibility ecosystem. The E in the ecosystem stands for responsible employment, the C stands for responsible citizenship, and the O stands for responsible operations. So employment meaning fair and inclusive labor practices, training and development, equity and diversity. Citizenship is all about the commitment to the community and the planet in terms of climate, and operations is in terms of ethical procurement, transparency, etc. Each of those three criteria is fundamentally assessed in every one of our investment decisions so much like we would evaluate an investment decision on the basis of supplier risk or customer concentration, etc., we also assess it on the basis of their E, C, and O score. But more importantly, sometimes we will acquire companies that actually may have a customer concentration, with the clear objective in mind that we are going to, over time, reduce that customer concentration. Similarly, we will invest into companies that may not have a sky-high sustainability score, but we have a clear agenda in mind in terms of improving that score, in terms of the outcomes that we own at the end. So that's our approach to this. And we are, yes, I agree that we are a little bit fortunate in that we are able to make that capital talk for us, right? It is not just talking the talk, it is walking the walk, and it's our capital that helps us do that.
Thank you. Why not we go to Ian now before broadening the debate? Ian, as I mentioned, you're leading a quite interesting organization in Australia, which is kind of a particular case to look at, given that Australia relies a lot on coal for domestic energy production. It's one of the largest exporters of coal around the world. That being said, you're also seeing the concrete impact of climate change. I mean, everybody has seen news reports on the floods and the wildfires over the past 2 years. Yet, the newly elected government, I shouldn't say yet, but given this backdrop, the newly elected government in Australia has announced fairly significant new targets for carbon emissions reduction. How will Australia do this? And can Australia become a blueprint for the world in doing that?
Thank you. And look, it's lovely to be here, even remotely, all the way from Australia. Yes, look, it's a very interesting time, as you say, Jean, in Australia. A new federal government's been elected with a far, I guess, greater ambition about carbon emission reduction here in Australia. Their undertaking is a reduction of 43% by 2030 on a 2005 baseline, and an increase in renewables as the in the energy mix here in Australia to 82% by 2030, which is a big increase. Today it would be about 27-28%, depending on which state you're in and what what time of the day it might be. So very ambitious goals from a new government. And as you say, in a country that has for decades grown up on cheap coal and coal-fired power across the country, so a very significant change in the environment here in Australia. And Australia is a country that is blessed with an abundance of sun and wind, so natural resources which can be harnessed to create very cheap, low emissions energy. And I think that's the very exciting thing about Australia, is it can transition in this way. The Clean Energy Finance Corporation, maybe just to sort of give you a flavour of who and what we are and what we're trying to do to help Australia with this transition. 10 years ago, a previous Australian government established the Clean Energy Finance Corporation, which is effectively a $10 billion green bank. So a pool of taxpayers' dollars able to be invested, both debt and equity, into the clean energy transition. So very broad-based investor. And today we've got something like $6 billion deployed out of the 10. So we still have quite a bit of capital there. And there's obviously ongoing recycling of our capital, because about 75% of what we've done or our balance sheet today is in fact debt-related investments, so project finance, in wind, solar, batteries, corporate finance to industrial companies that are decarbonising, green bonds, sustainability bonds, climate bonds. So all the debt side of our business is of course constantly repaying and refinancing, and we can use that capital to redeploy into the Australian clean energy transition. And then the balance, the 25% or so, is equity-related investments, and they can be in funds or directly in projects or companies, and they are across a whole raft of other sectors, invariably agriculture and infrastructure, greening the built environment here in Australia, transportation. Australia has a very low uptake today of electric vehicles. We're investing in EV recharging. Australia, of course, a very, very large country, big distances to travel. So getting people to convert to electric vehicles requires a confidence in terms of being able to recharge their vehicles. So there's a lot of work and a lot of investment that needs to be done. The big opportunities here, of course, are, as I say, increasing the renewable energy mix in the electricity sector. We've got a huge amount of work to do there, investing in wind and solar, over coming years, and storage, because as we replace coal-fired power, which is the predominant provider of energy here in Australia, we need to be able to balance that with dispatchable clean energy, and that's going to require a balance with large-scale storage. And the CEFC has been involved in some of the biggest batteries in the world here in Australia to date. I know that people are setting records around utility-scale storage almost every month, but a first couple of investments in that area saw us investing in 160, 150 megawatt style batteries in our electricity system. So the big challenge there to take up renewables is investing in transmission. So the grid in Australia is not built necessarily for this sort of aggregated, decentralised production of energy. So the CEFC has started making some substantial investments in the grid, and the new government has announced a $20 billion rewiring the nation policy, and that policy initiative is to put a further $20 billion into grid-related investments to allow this transition to take place. And the CEFC has been identified by the Australian government as the agency to do that. So we're currently working with the government exactly how that will look, what sort of financial products we will need to ensure this grid transition will take place. What will be included, what will not? Will we include just poles and wires? Will we also include large-scale batteries, synchronous condensers, grid-forming inverters? So a lot of the work is now kind of being done as to how we're going to implement this initiative of the new government. So look, it is an exciting time here in Australia as we transition away from a history of coal and coal-fired generation to one of renewables. And maybe one sort of parting kind of comment in this particular section, Eugene, is that green hydrogen is a very exciting opportunity for Australia, because we feel that we can tap into and harness our solar, our sun and wind, our incredible attributes there, and potentially produce some of the world's cheapest green hydrogen in decades to come that we could then transport in a suitable way to markets, particularly markets in Asia like Korea and Japan. So there's also a huge amount of work and energy being put into the emerging green hydrogen sector here in Australia. So yes, it's a there's a major transition going on, and capital, both debt and equity, is a key plank in delivering on that transition.
Thank you, Ian. Why don't I speed up the discussion and the exchange of views by asking a few rapid questions to our panelists. First, Hervé and Bruno and others, feel free to come in. You mentioned green taxonomy at the outset. That you're quite familiar, no doubt, given your vantage point on the debate we've had and are continuing to have, I'm sure, regarding the role of nuclear in the energy transition. What's the perspective of BNP on that? And I'd be interested in views of Bruno, for instance, if Boralex could consider, in some way, shape, or form, participating in France, notably in expanding or looking at, again, the role of nuclear in the energy transition. And I'm sure, Ian, you may have a perspective from Australia on that point. But quickly, let's do some rapid thoughts from each of you, if you want to comment on that.
I will navigate around your question. First of all, we do finance nuclear. We've always financed nuclear. We'll continue to finance nuclear. We have a very clear public policy around that. And your question, I was joking earlier, but your question relates to labeling, actually. The nuclear debate is whether you want to label this as a green or sustainable financing or not. So regardless of labeling, first of all, to your question, BNP Paribas will continue to finance nuclear for the time being under the conditions we've stipulated. Whether we would label a loan sustainable or not, I guess we'll follow the EU taxonomy on this. But we're not here to opine, on what has a place or not in the transition. I would say for the time being, both gas and nuclear are necessary, yes, we do finance them.
Yeah, I'd like to certainly. From our perspective, we focus, we're pro-renewable. Obviously, we focus on renewable. We focus on our business. Other types of energy are needed, will be needed for a while as base energy. As Hervé mentioned, certainly nuclear, gas, and other types. So we need to manage a transition. Managing the transition, I think, is probably is a bit more of a government role, and some big players in the private markets, but certainly first and foremost a government role to plan ahead many years, not only one political cycle, but many years. So as I've mentioned, we see in the countries we operate in ambitious targets, ambitious goals, but it doesn't. It needs to go further than that. It needs to be supported by constructive legislation, a clear and stable regulatory framework, and a facilitating administration. We need that more than just nice long-term targets. We need tools to enact those targets in the real world. In the planning with regards to transition on other types of energies, again, if it's nuclear in France, then that's fine. I mean, we've seen nuclear in France has had some issues. They're shutting down some of their power plants for refurbishment and so on, which in our view certainly speaks to more rapid development of renewable energy in a country like France and other places where nuclear or gas or fossil fuels are used. So time is of the essence. I think it's an important message, and it takes time to develop. We've had the example here in Quebec where a few years ago we were saying we're in a situation of surplus energy supply. And with what's happened over the last few years, with changes in the economy, changes in exports and so on, we're no longer in a situation of energy supply surplus. So and we, in terms of producer, need to plan ahead a few years before we get an asset in production. So we need that long-term view and planning. Governments can work with the private sector to disclose part of their hypothesis or assumptions under their planning to make sure that the private sector financing firms and so on adjust according to that to those assumptions.
Ian, do you want to comment on that, or shall we move on to the
very briefly? Australia has. Doesn't have kind of nuclear ambitions today. There's really, for many years, hasn't been a social license, if you like, for nuclear power. I think that debate still is on in Australia. The current government doesn't have any plans for nuclear energy. Interestingly enough, the Clean Energy Finance Corporation, there are two things. Energy or technologies that we are prohibited from investing in. One is nuclear and the other is carbon capture and storage. So it's not a fertile kind of ground here in Australia at this stage.
Thank you. Moving on to perhaps one topic you raised, Rishi, which is the importance of measuring progress. I'd like to have your general assessment of the progress made so far. We've been talking about financing green growth now for a number of years. Many things have been enacted. Governments have taken steps to encourage. Standards have been somewhat established. But when you look at where we are today, are we making a real impact on the energy transition? And the flip side to that, I mean, the narrative today, given what's happening geopolitically, is that the priority given to tackling climate change is going to change for some time. And perhaps the question I would have for you and for others on the panel, can one say or can one believe that effective policies to tackle climate change can be part of the answer to the current geopolitical environment and therefore can be part of the security mix?
Wow, you packed a lot into that one, Jean. Let's start from the back over there. So I think the one realization based on the recent geopolitical events, but also through the course of the COVID-19 pandemic, that most governments have come to is the fact that they need to be largely self-reliant in terms of their supply chains and their energy needs and their even food, something as basic as food. So is there an intrinsic overlap in a geopolitical sense between how a country assesses its own security perimeter and the need for them to secure their energy supply using whatever means appropriate for them? I think the answer to that is a resounding yes. Now, going back though, you were talking about the fact that the recent geopolitical events have potentially put a bit of a roadblock on the way to net zero and all of the commitments that both the public sector and the private sector have made worldwide. That may be so, but I think again, it's important to not confuse the short-term noise with the long-term signal. The fact that there is a certain critical mass of the global population, whether it's government or private sector or an actual mere individual, doesn't really matter. It has reached that critical mass where we recognize that the need for us to address the risks emanating from climate change are critical, right? Not important, not nice to have. Let's think about it, tomorrow, maybe the next generation can sort it out. No, that is not the case. I think there is a clear acknowledgement of the fact that we need to take action and implement what needs to be done to migrate large sectors of our current economic landscape to a net zero position. I actually think of this, rather than it being one of those situations where you think of it as a burden, oh, this is yet another cost that I have to incur, etc. We actually think of this as one of the most compelling long-term secular investment theses for the next several decades, right? Not just the next 10 months or 10 years, multiple decades. The technologies that are needed to support the transition to net zero by 2050 or thereabouts for most of the world, the good news is that most of those technologies, 70-80% of them, have already been invented. So this is not new discovery that we have to engage in. The challenge in front of us is scaling up those technologies and applying them beyond the obvious, beyond the renewable generation of power, into mobility, into distribution, into storage, into industry, into agriculture, into the built environment. That's where the opportunity sits. And we actually prefer, and when I use the word we, I'm actually using a little bit of a royal we over here, because we have the benefit of getting almost real-time feedback from our investors. And consistently over the last several years, at least 4, the top 3 investable trends that our investors have identified in no particular order have been climate change, investing trend, not a risk, right? They are actually identifying the opportunity around investing in managing climate change as a massive investment trend, digitization and aging demographics, healthcare, basically. So, this for us is really about taking the bull by the horn, so to speak, and capturing the opportunity presented by the need for us to embrace the journey towards net zero and the inevitable capital dollars that will flow as a consequence in the form of investment into it. So, we are going to be hopefully leading that charge, but certainly we are not in the place where we feel that it is a cost or a burden. You asked about, have we made progress on the frameworks? Are we? The answer is simple. Are we where we need to be? No. Are we better off than we were last year? Yes. There is clearly, even the SEC now has come out with guidance, for instance, in the US, that resembles to a large extent the SFDR framework in the EU. So there is, an attempt towards convergence. I think inevitably what is going to happen is, much like rating agencies historically used to assign ratings to corporates, predominantly on the basis of financial metrics, those ratings are going to start including sustainability metrics as well in that assessment. That is not imminent, but it is around the corner. And as a consequence, the risk weights that banks like BNP, to my left over here, would have to attach to those exposures will be influenced and impacted directly. And that is how capital is going to get channeled. This is not something that central bankers actually have to do anything about. Once the rating agencies harmonize around an assessment framework that incorporates a sustainability risk assessment alongside business risk assessment and financial risk assessment, this will be a natural consequence of that.
This is something I'd like to add on, actually, if I may quickly, Jean.
Please.
We focused on the opportunity side, but there is also the other side of the coin, which is transition risk. And as we progress in time, the emergence or the crystallization of those risks will accelerate the movement. So granted, we're not going fast enough and we'll probably never go fast enough, but time is not static. As we move forward, and we already see movement of capital where the companies especially in carbon-intensive sectors, but there are many, I could list 10 at least, depending on how those companies have transition plans today or not, we already see slight differences in pricing or investor discussions around those. So I think this will accelerate the movement.
Ian or Bruno, you want to add to that? If not, maybe I'll go to. We have only. Oh, go ahead.
Oh, no, I was going to say not
okay.
Not from my.
We have only 5 minutes left. So what I'd like to do a little rapid fire comment from each of you on two things. One is if we were to assemble here in 2030. One thing that you believe we'll have achieved by then, or not achieved, what would be a major accomplishment or a major disappointment 7 years from now? And I'm talking, I'm using time frames that are, tied to the long-term investment world. Let's just call it midterm, given the time needed to get investments online. And then secondly, your own assessment. We've been talking about the world being net zero by 2050. India talks about 2070, but let's just say being net zero in 3, 4, 5 decades. What's your judgment today on the percentage chance that we actually achieve that by this broadly stated time frame? And I'd like to start this by the reverse order of the initial comments. So Ian first, then Rishi, then Bruno. Then Hervé.
Hey, Jean. Look, just a couple of thoughts from me. In the next, let's say, decade, some of the great kind of achievements that I would like to think, if we reconvene, that we would be talking about or seeing, would be the establishment or the active participation in a global green hydrogen market. I'd like to think Australia would be playing a huge part in that. I'd like to think that green steel and green aluminium were active, products used and implemented kind of around the world. And I think international carbon credit markets. I'd like to think, well, if we were to reconvene in 2030, we would be talking about how successful an international kind of framework and market would be operating. I think there's a lot to be excited about, and some of those items would be great to really take off over the next decade.
And your percentage would get there, 2050, 2070?
Look, I think we have to get there, Jean. I think there's no question. I'd like to think it's 100%. Optimistically, there is no other way of tackling it.
Okay, Rishi.
Okay, so on question number one, in terms of sitting here in 2030, I think by that time we'll have clear pathways established through technical innovation for achieving net zero on some of the other sectors of the global economy that we touched upon earlier, which is storage and distribution, mobility, industry, agriculture, and the built environment, and capture and removal, direct capture and removal. So I think 8 years from now, we'll have well-established and scaled technologies for each of those 6 areas. The likelihood of us meeting our net zero target by 2050, I'm actually in Ian's camp. I think we get there. I mean, 100% is hard for me to say because in investment, 100% is it. But you get the drift, right? I have a 95% confidence that we'll be within plus minus 5 years.
Bruno?
Being a CFO, I'm not going to speculate on a percentage in that many years. But
there's a disclaimer.
But I will say that I'd certainly like to be and believe that we need to get there and we'll get there. But we need, in my view, we need rapid action. We need increased cooperation between the public and the private sector. We need stronger financing incentives for the sustainability-linked loan that we did. We get 5 basis points of break if we meet our targets. That's net, not even a financial benefit because we pay additional costs to measure those things. 5 basis points on a loan is not a financial meaningful break. So we need better financial incentives for sustainable financing. It's important. It needs to happen soon, and I think there's a market for the firms that will be more aggressive on that front. Our clients, private companies, are asking for more renewable energy than we can provide. The need is there, the demand is there. So we need to put these things in action faster, in my view. But I'd like to believe we can get there.
Thank you, Hervé. Our time has lapsed, but you have the chance to conclude. Any final thoughts on this or any other topic?
So 8 years ago, when I started this initiative at BNP Paribas, no one would have thought that every CEO in the world would be talking about sustainability in 2022, or that we would see interest rate moving up or down in relation to the achievement or not of sustainability targets. So 8 years from now, I think people will have the wow factor that transition risk do indeed exist, that capital access will have been disrupted for some corporation, that some others will have been massively disrupted by transition risk in no way that we foresee today. But I think we'll see that in 2030. As to whether we'll achieve net zero, if I have to bet, I would say no. But listen, if we achieve net zero, we'll have 2 to 3 meters of sea level rise. If we do nothing, we'll have 62 meters. So whether we achieve it or not is not the issue. Everything we do means something. It's not an all or nothing. It's between 2 and 62. We won't be at 62.
Thank you, everyone. Thank you for your participation. Hopefully this was interesting for our audience.